Stop what you're doing. Seriously, if you own any real estate development stocks, or if you've just been watching the massive land rush down south, you need to hear this. Last week, I ran one of the most fascinating and contradictory assets in the market right now, the St. Joe Company, through 5 hardcore financial valuation models and 2 legendary investing checklists. And honestly, what I found completely shocked me. It plays perfectly into a retail investor's worst nightmare, buying into a massive, undeniable physical growth narrative right at the absolute peak, only to watch the financial fundamentals completely collapse beneath you. But don't worry, today I'm promising you a clear, actionable framework. You can steal this exact process to evaluate land-heavy companies just like this one, so you can separate the physical hype from the mathematical reality. So that brings us to the core question for this explainer. Is Florida's biggest real estate giant actually overvalued? Are we looking at a generational wealth builder or a value trap just waiting to spring? I mean, you really have to wonder what Warren Buffett or Peter Lynch would think if they looked at a company experiencing an incredible physical boom, yet where strict financial models suggest a stark disconnect. It's a true contrarian puzzle. But by the end of this explainer, you'll know exactly whether St. Joe is a Buffett-style buy you can hold forever or a Lynch-style trap that looks great on the surface but completely falls apart under the hood. To understand the sheer scale of the St. Joe Company, you really have to wrap your head around this staggering number, 165,000. They own 165,000 acres of land across Northwest Florida. To put that into perspective, think of them not just as a traditional real estate developer, but almost as a sovereign nation of real estate. They essentially control the destiny of the entire Florida panhandle. This isn't just a portfolio of properties, it's an absolute empire of dirt. And this land entitles them to originally develop over 170,000 residential dwelling units and over 22 million square feet of commercial space. The physical growth potential is mind-boggling, but how does all that dirt actually translate to cold, hard cash? Here's our agenda for today. 1. Florida's real estate giant. 2. Record revenues and growth. 3. The Q1 profit slip. 4. Who owns St. Joe? And 5. The valuation disconnect. Section 1. Florida's real estate giant. Let's map out this empire. Their regional dominance is absolutely undeniable. 87% of their real estate is concentrated in just 3 counties, Bay, Gulf, and Walton. And a massive 90% of their land holdings are located within 15 miles of the Gulf. They are positioned perfectly to capitalize on the massive migration and demand we're seeing in Northwest Florida. They aren't just participating in a market trend, their geography literally dictates the market trend. Section 2. Record revenues and growth. Here is where the physical expansion pays off. They are aggressively leveraging strategic partnerships to monetize all that land. In fact, they just announced a new builder relationship, executing a contract with Pulte Group. For a little context here, Pulte Group is the nation's 3rd largest home builder, and this marks their very first entry into Northwest Florida. They're planning to potentially develop over 2,600 home sites along the State Road 79 corridor. When a national heavyweight like Pulte steps into your territory, it absolutely validates the demand. So the crucial point is that this aggressive physical expansion led to a massive financial payoff in their 2025 annual report. Total revenue increased by 27.4% to over $513 million. Their real estate revenue alone jumped an incredible 63.5%. And with Pulte Group becoming their 19th homebuilder partner, their development pipeline is just absolutely humming. I mean, if you stop the analysis right here, the company looks like an unstoppable growth machine. Section 3. The Q1 profit slip. This is where the plot thickens. Top-line revenue for Q1 2026 came in at $99.04 million. That's their highest first-quarter revenue outside of a one-off timberland sale way back in 2014. Hospitality and real estate revenues were up across the board, yet bottom-line net income actually slipped to $13.93 million, down from $17.46 million the previous year. You've got to ask yourself, how does a company generate record top-line revenue but lose ground on the bottom line? To understand exactly why profits fell despite rising revenues, we need to talk about a specific accounting mechanism: unconsolidated joint ventures. These are basically business arrangements where St. Joe partners with others for development, sharing the risks and the capital costs, but they do not have full controlling financial interest. It's a core strategy for the company to diversify their business and leverage industry expertise, but it also means the financial reporting gets a little complicated. And right here is the smoking gun for that Q1 profit slip. Equity and income from these unconsolidated joint ventures fell sharply, from over $10 million in Q1 2025 down to just $3.52 million in Q1 2026. This specific drop in joint venture income was the primary anchor dragging down their total Q1 net income. It beautifully highlights the complex dynamics of their business model. They are highly reliant on the timing and success of these external partnerships to drive their bottom-line profitability. Section 4. Who owns St. Joe? Let's follow the money. Retail investors make up just a tiny slice of the pie here. Wall Street heavyweights are deeply entrenched, controlling a staggering 86.67% of the company's shares. When you see institutional ownership this high, it usually tells you that the smart money has highly convicted, long-term views on the underlying value of the asset. But it also means the stock price is completely at the mercy of their portfolio rebalancing. Just look at the flow of capital over the last 12 months. It's a high-stakes tug-of-war. You have 164 institutional buyers pouring in nearly $170 million, fighting against 104 institutional sellers pulling out roughly $174.5 million. It is incredibly balanced. Major players like Fairholme Capital Management, Vanguard, and State Street are navigating a highly scrutinized institutional battleground. They're all looking at the exact same Florida dirt, but they're coming to very different conclusions about what it's worth right now. Section 5. The valuation disconnect, the physical footprint versus the financial reality. Let's get into the hardcore numbers from valueinvesting.io. This is the framework I promised you earlier. When you run St. Joe through standard valuation models, the picture gets very grim very fast. Across almost every major model, the stock shows significant downside risk from its recent market price of roughly $63. Whether you use a 5-year discounted cash flow model based on growth, an earnings power value model, or a stable dividend discount model, the intrinsic value sits anywhere from $28 to $47. Literally none of these mathematical models support a $63 stock price. This single metric captures the immense tension of this asset perfectly. According to the primary DCF growth model, the stock is overvalued by over 34%. This is the ultimate contrarian puzzle. You have a company physically booming in Florida, signing national builders, and posting record top-line revenues, yet mathematically, it's flagged as significantly overvalued because the cash flows and joint venture earnings just don't currently justify the massive premium Wall Street has placed on the stock. So I'll leave you with this final thought to consider. Will the reality of St. Joe's massive Florida land boom eventually generate the cash flows needed to catch up to its valuation? Or is Wall Street pricing in a level of flawless, perpetual growth that the fundamental numbers simply do not support? It's a classic battle of physical assets versus financial metrics. Thank you so much for joining me for this explainer, and as always, keep your eyes on the data.